For all the replay viewers, that's the camera. That's Deji. That's Deji's computer. And that's me. Is it rolling? Yeah. Oh, okay, cool. So let me just flip this. Come on. Okay, cool, perfect. Here we go. Just right there so that you're out of the picture. And episode 21. What's up, everybody? My name is Arman Vakili. This is episode 21 of the hashtag Everything Money show, where we talk about everything that has to do with money. And being that it's episode 21, and I put on one of my nicest sweaters that I could find, and I just noticed that the makeup from when the girl was doing my makeup just got all on my sweater. So hopefully it doesn't show up in production, post-production, or whatever we're doing. So it's episode 21. We're getting more and more and more advanced with our content and our information. I'm getting really good feedback because as we're doing this, as we're doing the recording for this, we're also live on Periscope. And just in case you're not following me on Periscope, boom, right here. This is the Periscope, right here. So download the Periscope app and then follow this guy right here, right here. And so we get a lot of live feedback and positive feedback on Periscope, letting us know what's working, what's not working, what content people like, so on and so forth. And so far, it's been really good. So I'm really excited about it. I hope you guys are getting a lot of value from this as well. 21 episodes deep, that's no joke. I know a lot of people that never made it past like episode 5. I almost stopped at episode 5, so I'm really excited about the fact that we're here. And today's episode is going to be about the different categories of life insurance. So originally, when life insurance was first invented, there was only term insurance and there was only whole life insurance at the very, very beginning. And this was around the time that life expectancy was like 60 years old anyway. So if you, like literally the oldest person was 60 years old and they would die at 60. And so if you're 30 years old and you buy a 30-year term insurance, which means what, at the end of the 30 years the policy is gonna lapse and you have no insurance anymore, but you were gonna die at 60 anyway, you weren't expected to live past 60, so that 30-year term actually covered you pretty much for your entire lifespan. And then when people started living a little bit longer, it turned into this thing where it's like, okay, well, 30 years is not going to work. And when I die or when I get older and I'm 65, 70 years old, that's when I need my insurance the most. And so I don't want it to expire, or lapse is the term that they use. So I don't want it to lapse and I don't have coverage anymore. And then if I wanted to renew my term, it would be way more expensive to do it down the line, right? Like when I'm 65 years old than it is compared to 30, because right now I'm 30 years old. Oh my God, that just kind of depressed me for a second. I'm about to be 30 years old in like a couple of months. And what's going to happen is that my insurance policy right now, for me to get a $500,000 term policy, is like $20, $30 a month. So super, like dirt cheap, right? But if I wanted to get the same exact $500,000 life insurance policy, term, right? Same exact life insurance term policy. 30 years from now, it's going to be at least $500. At least $500 per month, right? So when people started noticing that, hey, we're living longer and we actually need to get something that's permanent, that's going to last until I last, or until, whatever my life expectancy is going to be, they created something called whole life insurance, which then eventually turned into universal life, and then variable universal life, and then index universal life, which is all cash value insurance policies. And so the way that it works is that term, like basic term, is the cheapest insurance you can buy. Cash value is the most expensive that you can buy. And then there's something right in the middle that came out relatively recently, which is called return of premium term insurance, which as far as the expense level is concerned, is kind of like right in the middle. And so typically, most people either know that there is term insurance or they know that there is cash value insurance. They have no idea that there's something in the middle. And just like the name implies, you get your premium back, right? So let's say I buy a 30-year term, Periscope. Let's say I buy a 30-year term, and 30 years from now, I don't pass away. All of those tens of thousands of dollars that I put towards that policy as far as premium payments are concerned are all going to be returned back to me, and I'll get a lump sum check for all of the premiums that I put into that policy, right? Pretty cool. You don't get any interest, you don't get any value on top of the money that you put into it, but at least you get all of your premiums back, which is a really big deal, especially considering that that was never even available, right? So for anybody that has term, I highly recommend just switching it to return of premium term, because you're gonna get your premium back. You're gonna pay a little bit more in premium payments. Your premium is gonna be more expensive for the same exact amount of insurance that you're going to be getting. However, you're going to get all of your premium back, which is a really big deal. So imagine if you're paying $1,200 a year, an insurance premium after 10 years is $12,000, after 20 years is $24,000. Imagine getting all of that premium back if you don't pass away. And not more than 90% of term insurance policies never pay out, meaning that the person who owns that policy doesn't die when they're supposed to die, and so the insurance company gets to keep all of that premium. And so it's like, if that's the case, if that's what's going to happen, and you don't have the budget right now, or you don't have the income level, whatever it may be, to actually dedicate a high premium towards cash value insurance that's permanent, that's going to last until 120, 130 years old, if you don't have that, then your next best option is to get something that the cost is relatively inexpensive, but you're actually going to get all of your premiums back. And these are the things that, again, so it's really, really super basic. Everybody should know about it, but everybody doesn't know about it. And that's the reason why we put this show together. And so this is actually pretty much it for episode 21. Super short, super concise, and super valuable, I would hope so. So if you're watching this, you probably fall into one of, let's say, 4 groups. The first group is you don't have insurance at all, which at that point, my biggest question to you is, do you actually value yourself as a human being? Like, do you think that your life is worth something? And I'm not trying to sell you on anything. I'm simply asking a question because I have a cell phone. I have insurance on my cell phone. I have a car. I have insurance on my car. We have rental insurance. We have insurance. I'm pretty sure Deji has insurance on his laptop and on his recording equipment. So it's this thing where we insure everything in our lives except our life. And it's like, okay, let's say you're the head of the household. Let's say you're the husband. You're bringing the income in. And then you have your wife and you have your 2 kids. And you're paying for their car insurance, their phone insurance, and you're paying for all of these different things. And so, God forbid, if something happens to you in that moment and you haven't put a policy aside for yourself, what do you think is going to happen to your family? Do you think your bills are going to stop tomorrow? Do you think that the funeral home is going to be compassionate about the fact that you just passed away and they're not going to ask your wife to put down $30,000 to bury you? These things are real. They happen on a daily basis to tens of thousands, hundreds of thousands of families, millions of families. 40% of the entire United States doesn't have insurance at all. And then you wonder why they say the rich get richer and the poor get poorer. It's super basic. The rich actually go buy insurance policies. And when they pass away, they pass down this $10 million insurance policy to their beneficiaries, and they teach them, hey, listen, the first thing that I want you to do is go buy another insurance policy for yourself. And make sure that it's a cash value policy, make sure it's a permanent policy so that it'll just last however long you last, and then you can pass this massive lump sum of money to your kids. And then they pass it to their kids, and they pass it to their kids. Whereas the poor don't buy insurance, and so when they pass away, the family has to go do either some kind of a car wash or some kind of a fundraiser or borrow money from family and friends, so on and so forth, just to bury you. And then, okay, how do I pay the bills next month? Oh my God, I'm a single mom now. I have 2 infant kids. I have to figure out a way to work full time so I can actually keep the roof over our head. If you have a mortgage right now and if you have a house and you're the main breadwinner, you have no life insurance, which is retarded, excuse me, but it's stupid if you have a mortgage and you don't have any life insurance. But let's say you have life insurance let's say you don't have life insurance and you have a mortgage, your wife has to take care of your 2 kids. Most likely, whenever you do pass away, because death rate is at 100%. Whenever you do pass away, your life is not going to be able to maintain the payments on that house, so then she's going to lose the house. And now she has to move into a tiny studio apartment, yada, 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 blah, blah, blah. Kids aren't going to be able to go to school anymore. There is no such thing as a college fund for those kids anymore. There are just so many things that comes along with having a simple life insurance policy that as a term policy, like get a 5-year term policy or a 10-year return of premium term policy doesn't cost a lot of money. And so if you're worried about the cost of it, it's ridiculously inexpensive to get one right now. And you're covering all of your bases and you're making sure that your family's set. So that's group one, that they don't have insurance. Group two is they have term insurance. For you, super easy. Switch it to a return of premium, so at least you get all of your premium back and then you still have your coverage, right? That's the second group that has term insurance. I really don't think there's anybody that's watching this that already has return of premium insurance. However, if you have return of premium term insurance, my recommendation would be try to figure out a way that you can budget and you can figure out in your finances what would be viable for you, that you can switch from return of premium to cash value, so at least you're earning interest on the premium payments that you're putting into it. And then the last group is the people that actually have cash value insurance, which at that point I would be curious, do you have whole life, universal life, variable life, or index universal life, and which company are you with? Because each company offers different benefits, each company has different fees, and for the same $500 that you would be putting inside a cash value policy at ABC company, you might be getting way more cash value putting that same exact money with the same exact insurance benefit into XYZ company. And so it's fully dependent on which one of those groups you fall into, and fully dependent on what you see as the goals and plans for your life. Now, what's awesome is that at Flawless Financial Consulting, we have licensed representatives that are extremely knowledgeable specifically on this topic, because this kind of hits close to home for me. My grandmother, God bless her, she didn't have disability insurance, she didn't have health insurance, she didn't have life insurance. By the time that my uncles and aunts realized that she needed all of those things, it was too late and she was too old to get all that stuff. And so now they're paying for the costs of everything that it takes, like everything that's required to take care of her. They're paying for all of those costs out of their pocket. So speak with one of our licensed consultants. Definitely take out the time. It's totally free. There's no obligation to any of that stuff. And it's something that I think you should definitely leverage. And if we can save you money, awesome. If we can't save you money, no hard feelings. If we end up doing business, amazing. If we don't end up doing business, we love you, and at least we got a chance to give you some free value. My name is Arman Vakili. This was episode 21 of the Everything Money Show. Thank you guys so much for watching. Subscribe, like, comment, share the video, and all that great stuff. You already know what to do, so I don't think I have to preach and beat a dead horse. And Deji is giving me like the rapid signal. I think this is like, is this the rapid signal? Is this how, are you just gonna cut? Do you just want to cut? You can just cut. Just stop me in the middle of my sentence. Just stop it.